Hi ladies and gentlemen. Welcome to Zero Digital Trend Trader. In this content we will discuss about equity market and equity derivates. An equity market, also known as the stock market, is a platform for trading in company shares. It is the place where buyers and sellers meet to trade in listed companies. Listed companies are those entities that have offered some part of their equity to public investors. Understanding an equity consists of funds that shareholders invest in a company plus a certain amount of profit earned by them that is retained by the company for further growth and expansion. Equity is a primary asset class when it comes to investing and diversifying one's portfolio. Trading in equity needs in-depth analysis and research of the share market, services that Zeroda offers to all of its investors. Additionally, derivatives allow equity to diversify beyond just shares into securities such as bonds, commodities and currencies. Trading equity may be traded in the primary market, when a company makes an initial public offering (IPO), and new securities may be bought. Shares that have already been issued are bought and sold in the secondary market. Investors may also own private equity, that is, shares of a company that is still private and not listed on the bourses. In order to trade in equities, investors must have a demat account and trading account. Benefits of equity share market investments, in comparison to other types of assets, have given one of the best returns during inflation. This enables investors to maintain their current lifestyles without cutting costs even when the prices of goods are steadily increasing. Equity, while being a risky investment, offers higher returns than a savings account or a fixed deposit because the profit that may be earned is virtually unlimited. It is possible to minimize risks and maximize profits through the use of equity derivatives, specifically by trading in the options market. Using sound share market knowledge to invest in equity is the key to building a large corpus for a future financial need, because equity gives high returns in the long run. Investing in the equity of reputable companies has the added benefit of dividends. Dividends are payments that shareholders receive from the company's earnings. While giving them out is not compulsory, established businesses do pay dividends to increase their shareholder base. Equity for a shareholder. Apart from knowing the value of equities in which one has invested, it is also important to know the value of personal share of equity, which may be calculated by subtracting total liabilities owed from total assets owned. Equity equals value of assets, value of liabilities. Equity investment returns. Return on equity measures a company's ability to use its investors' funds to increase its profit and earnings. It is important to keep track of equity returns to understand if there are long-term benefits from investing in a particular company. Types of equity markets. Primary market. Every company that proposes to go public must come out with an initial public offering (IPO). During the IPO, the company offers a certain portion of its equity to the public. After the closing of the IPO, the shares are listed on one of the stock exchanges, which are an important component of the stock market. The primary exchanges in India are the National Stock Exchange (NSE) and the Bombay Stock Exchange (BSE). Secondary market. After the listing of the IPO shares, these are traded on the secondary market. This platform offers the initial investors an option to exit their investments. In addition, investors who failed to procure shares during the IPO can purchase these from the secondary market. Trading in the Indian stock market is commonly done through brokers. The brokers act as intermediaries between the stock exchanges and the investors. Equity market procedures. Trading. The stock exchanges provide an automated screen-based trading platform that is fully automated and computerized. The platform is an open trade system where buyers and sellers can see all the trades and place their orders to suit their personal requirements. Clearing and settlement. The exchanges clear and settle all the trades that are executed during the trading day. These exchanges operate well-defined settlement cycles without any deviations and/or deferments from the procedures. The trades during the trading session are aggregated and positions are netted off with the objective of determining the liabilities of the trading members. These procedures also ensure movements of the funds and shares are completed in the right manner. The settlement cycle adopted by the exchanges operating in the Indian stock market is T+2. This means that all securities and funds movements are completed 2 days after day 1, which is the day on which the trades are executed. Under the T+2 cycle, buyers receive credits of the shares in their Demat account, and sellers receive the sale proceeds in the bank accounts that are linked to the trading account within 2 days. Risk management. A widely known stock market basic is that investing in the equity market has several risks. The stock exchanges have developed a comprehensive system for risk management. This system ensures the investors' interests and prevents fraudulent activities by the companies. The stock exchanges constantly upgrade the risk management system to preempt market failures and stay abreast of the changing mechanisms. Some components of the risk management system include margin requirements, pay-ins, and voluntary close-out facilities, and liquid assets. Equity market investing can help investors meet their future financial requirements by beating the rising prices due to inflationary pressures. Understanding the stock market basics and learning more about the market and its regulation, and following a disciplined approach to share market investment can provide huge returns in the long run. Equity derivatives. The National Stock Exchange of India Limited (NSE) commenced trading in derivatives with the launch of index futures on the 12th of June 2000. The futures and options segment of NSE has made a global mark. In the futures and options segment, trading in Nifty 50 Index, Nifty IT Index, Nifty Bank Index, Nifty Next 50 Index and single stock futures are available. Trading in mini Nifty futures and options and long-term options on Nifty 50 are also available. The average daily turnover in the F&O segment of the exchange during the financial year April 2013 to March 2014 stood at 1.52236 trillion rupees, 21 billion United States dollars. On the 29th of August 2011, National Stock Exchange launched derivative contracts on the world's most followed equity indices, the S&P 500 and the Dow Jones Industrial Average. NSE is the first Indian exchange to launch global indices. This is also the first time in the world that futures contracts on the S&P 500 index were introduced and listed on an exchange outside of their home country, USA. The new contracts include futures on both the DJIA and the S&P 500 and options on the S&P 500. On the 3rd of May 2012, the National Stock Exchange launched derivative contracts, futures and options, on FTSE 100, the widely tracked index of the UK equity stock market. This was the first of its kind of an index of the UK equity stock market launched in India. FTSE 100 includes 100 largest UK-listed blue-chip companies and has given returns of 17.8% on investment over 3 years. The index constitutes 85.6% of UK's equity market cap. On 10 January 2013, the National Stock Exchange signed a letter of intent with the Japan Exchange Group, Inc. JPX, on preparing for the launch of Nifty 50 Index Futures, a representative stock price index of India, on the Osaka Securities Exchange Co., Limited. OS, a subsidiary of JPX. Moving forward, both parties will make preparations for the listing of yen-denominated Nifty 50 Index Futures by March 2014, the integration date of the derivatives markets of OS and Tokyo Stock Exchange, Inc. ZE, a subsidiary of JPX. This is the first time that retail and institutional investors in Japan will be able to take a view on the Indian markets, in addition to current ETFs, in their own currency and in their own time zone. Investors will therefore not face any currency risk, because they will not have to invest in dollar-denominated or rupee-denominated contracts. In August 2008, currency derivatives were introduced in India with the launch of currency futures in USD-INR by NSE. It also added currency futures in euros, pounds, and yen. The average daily turnover in the F&O segment of the exchange on 20 June 2013 stood at 419.2616 billion rupees, 5.9 billion United States dollars in futures and 273.977 billion rupees, 3.8 billion United States dollars in options, respectively. Interest rate futures. In December 2013, exchanges in India received approval from market regulator SEBI for launching interest rate futures (IRFs) on a single GOI bond or a basket of bonds that will be cash settled. Market participants have been in favor of the product being cash settled and being available on a single bond. NSE will launch the NSE bond futures on the 21st of January on highly liquid 7.16% and 8.83% 10-year GOI bonds. Interest rate futures were introduced for the first time in India by NSE on the 31st of August 2009, exactly 1 year after the launch of currency futures. NSE became the first stock exchange to get an approval for interest rate futures, as recommended by the SEBI RBI Committee. Debt market. On the 13th of May 2013, NSE launched India's first dedicated debt platform to provide a liquid and transparent trading platform for debt-related products. The debt segment provides an opportunity for retail investors to invest in corporate bonds on a liquid and transparent exchange platform. It also helps institutions who are holders of corporate bonds. It is an ideal platform to buy and sell at optimum prices and help corporates to get adequate demand when they are issuing the bonds. To open Demat account, link has given in description. Thank for watching. Subscribe for regular updates. Hit the bell icon for notified.